All right. Welcome back, everyone. It's our final session of the Angel Training course, and it's very nice that the faces from day 1 to day 5 haven't changed a lot, so you haven't dropped out, so that's good. So today we have 2 great speakers, one of them being Martin Čmelants from McKinsey, and the second one joining us from Lithuania, Andra from First Pick Ventures. 2 completely different topics. Martin will be talking about exits and preparing for an exit as an angel investor. And Andra will actually cover a lot of things about Baltic Startup Funding report, investment agreements, and so on and so on. A lot of details there. But just a few updates from our side. So in terms of the 3 startups that you like, then we are still in the process of gathering information from them and analyzing them. Basically, with Boomio AI, we're reaching more progress than with the other 2. They're expecting to perhaps downsize their round in order to kind of save the impact on their cap table. Plus, we already have scheduled some online calls with the team that you can also join. And until then, we probably will have a preliminary investment opinion formed on them. With Lexo AI, and we have signed the NDA to start the document collection. Plus, they are very much eager to also organize a on-site meeting with the interested people and investors sometime mid-November to kind of also touch base face-to-face and talk through details in that way. And they're telling me we're still in the document collection phase, but there's no worries about this being the last session because we will still be keeping you informed and updated about what's going on with these companies. So you will still hear updates about that. But yeah, today, I guess we can start with the first speaker, Martin Čmelants. Yeah, round of applause. I think you can do the intro about yourself.
I can.
Quite quickly. Yeah.
Hey guys, great to be here. So my name is Martin. We speak in English, right?
Yeah.
That's fine. Okay. So I have been in private markets for 20 years in different roles. I was an investment banker in early days in the Baltics here. I was in private equity then, and sort of for the last 13 years, I've been part of McKinsey's private equity practice. As the side hobby, I do investing as well. I have invested in seed, pre-seed, and sort of angel rounds in more than 10 companies in 10 different countries. As an individual investor, through syndicate, through a fund, and also through secondaries. So I also can sort of share a couple of ideas on what to look when sort of like we are thinking about choices. And today the topic which Emil's asked me to kind of quickly talk about was around exits, right? Because sort of like the ROI of investment is realized only in the point where you see proceeds coming back to your account. And by the looks of your faces, you haven't seen yet the massive proceeds sort of like coming back to your accounts. And we're gonna touch upon that, and sort of like what I will kind of think through is I'll talk about the exit context in general right now, and then sort of like what is the exit procedures looking from the fund perspective, and then how does the angel can play an active and also collaborative role as in that process. Of course, we're going to stop, and we have a lot of questions as well, so feel free. I think I don't want to be kind of very one-sided, so happy to also take questions from the audience on the fly. I would say, so let's kind of start with a quick context, right? So I think, so what is the successful exit in 2025, and how you think about that is, so you have to frame things in different ways for different stakeholders in the process, right? Because from one side, you have, of course, the capital providers, which are the funds, the angels, the different fund of funds, or kind of direct money providers, asset managers, like, and then you have on the receiving side, you have either GP who receives your investment, and then sort of the fund, or you would perhaps have individuals who are receiving the money. The success of the exit is dependent from the expectation. Every single angel investment, the expectation or starting expectation should be it goes to zero, by definition, right? So effectively, as good you manage your expectations in a very first idea, more satisfied you're going to be in the process. So I think I probably assume that you have already spoken before about like overall construction of the private markets portfolio and where does angel investment sit in that, because essentially it's not necessarily the only asset class you should be exposed to, meaning seed, pre-seed, or angel rounds. And also, it's probably not the one you would start with because it has the most uncertainty, it has the longest time to liquidity, and it also has the least amount of information to do underwriting decision, right? So, and you underwrite mostly character, not even the idea, the market, or any other things, right? So, like angel round underwriting, in my mind, is really sort of the character underwriting of the individual founder you're supporting. And therefore, kind of when I think about exits, like I will give you the picture from mostly the fund's perspective, right? Because the angel is tied to the next institutional investor who's willing to, in some way or forms, enter the market or exit if it's sort of like you're together with a VC player. So I would say, I would use a couple of acronyms here, and I would like to kind of quickly debunk them up front. So when I say GPs, general partners, so basically every single fund, is it either a pre-seed fund, VC fund, later stage growth equity fund, they all qualify under GP term. DPI is sort of like the distribution to paid-in capital, so kind of the flow back to the investors. And then perhaps you see here a couple of times the term LP or limited partner. Limited partner will be someone who is actually providing the capital to the GP community to invest and do active investments. And in some ways and forms, angel investment is a limited partner like stakeholder, right? You provide capital for either through a fund, through a syndicate, or individually directly to the founder to be managed in the best possible way to provide you the best possible risk-adjusted return. And again, like what is the right expected angel investment return in 2025? There are many ways how to think about it, but how I would think about it is, so number one, it's not one investment return, it's a portfolio return, because as I said, most of the things will go to zero. So if you do angel investing, don't do less than, I would say, 7 or 8 investments. If you start doing angel investing, you should do 7 or 8. Otherwise, it's not the right asset class for you. It's not the right strategy for you. Because if you don't do 7 or 8, and most importantly with similar size tickets, you will kind of really have no correlation with the expected return, right? Second is, today, the exit takes longer than it used to take. The angel round used to take around 8 to 10 years. Right now, you're talking about 12 to 14 years. And even if you 10x the money, if you think about 14-year horizon, that will give you only 55% IRR, right? And it will be probably 1 or 2 of your investments. So, and again, angel investing in some ways and forms is kind of looking for a unicorn.
Well, you say 12 to 13 years is from the scratch to IPO, or what's the?
So, yeah, like we're going to talk about different exit scenarios, but of course, let's say on average, I would expect that is sort of like from the initiation of the company, so sort of like the idea round, then you would go through pre-seed, seed, Series A, Series B, Series C, Series D stages. Then you go through the growth stage, and then you would go through some type of exit. Strategic trade, sale, IPO, all the options are available. That doesn't include you can sort of like take a reroute in between, right? So like, and we're going to talk about different options, like how you can try to monetize your illiquid stake. So that would be the full holding period. So if you, let's say, sell to someone else, a secondary transaction, a transaction of the consolidated safe notes, converts, and like you sell to Series A, that can be sort of like within 3 to 5 years, right? But I think, always think from underwriting perspective, they're going to take twice as long, and the returns are going to be twice as low. So then at least you're in the right mindset to kind of start thinking about this asset class in the right possible way. So having said that, so macro has negatively affected, in this year specifically, the exit markets across different asset classes, being venture capital, growth equity, and private equity. Growth also has hindered in most of the spaces where people are putting real money to work, and that has been to the many different markets. And again, like my discussion is from a global perspective. And I'll try to be as relevant as we can for Europe and then for Central Eastern Europe specifically. So therefore, like, as you kind of prepare for the exit, I think preparing a very compelling equity story becomes harder. So why equity story matters in exit is the buyer buys the future of this company. So like, let's say you're an angel investor, you're investing in the company, you want to exit in a Series A. In Series A, like, there's a VC coming on board and investing, let's say, $2 to $5 million in that company, and he wants that to become 50. So you need a very compelling equity story for them to be convinced that this is the right company and the right opportunity. And to create that compelling equity story becomes increasingly harder because the uncertainty increases. Technology risks, let's say, Trump tariff risks, different geopolitical implications on things, China, like, there are many different topics which increase uncertainty and therefore decrease the ability to predict future cash flows of a certain investment opportunity. So therefore, compelling equity story is even more important because the variables are kind of significantly more complex. You have to show that in that exit process, you're able to create value even before understanding the full value capture, right? And I think therefore you have a term called like value capture sprint across all the different development stages of the company to say, even a company which is just in post MVP process can show path to the first 1,000 customers very quickly. That they can show the way how they can identify the customers very quickly. They can convert them and kind of prevent the churn very quickly. So whatever stage your target company is, you always can show them very specifically how they can, by doing certain things, capture some of the value in a sprint-like manner. And then, of course, when you think about the growth, I think, so the value creation is going to be the most important element in most of the later stage investing, and then this creeps into the early stage. When we think about private equity, in the last vintage, which starts in 2025, so vintage year in private equity is sort of the same as wine, right? Like, you think about grapes harvested in a certain year, in certain conditions, and then you compare them against other grapes in the world. In private equity is this exactly the same. You have vintage year of private equity is like compares the time when everyone invested. Everyone had the same information about the future and the same macroeconomic conditions in the same geography. So you can tend to compare vintages. And then within the vintage, you typically would dissect performance. We're going to talk about that later. And sort of the latest trend is that the most value comes from the value creation. So alpha, 55% of the extra alpha generated on private equity assets is from value creation. And that tends to kind of go down to the VC and growth equity stage as well. So not like you kind of don't anymore have these very specific like market-driven thesis, like everyone invests in AI, like let's put some money down and let's hope that the sort of my AI bubble will kind of make them float. Today, even in VC and earlier stages, you see more specific need for targeted value creation, and that is going to be able sort of to explain why certain companies succeeded and why others didn't. And also the same why certain VCs and certain investors succeeded and someone didn't, because of the specificity and ability to create more value. And of course, kind of for the compelling equity story, kind of the idea is also to make company ready for the exit. And that includes things like, let's say, organizing a cap table. So if you have, let's say, we're here like 30 people, if we have all invested in one company, like a next round, let's say, investor doesn't want to deal with 30 people. So like you have to organize yourselves. You have to kind of make sure how to also clean up the cap table, let's say, make sure that the founder understands how to clean up also like the inter-party connected loans, making sure like there are numbers presentable, that he's ready for something like called quality of earnings analysis. And there are many different ways also you as a more experienced person in sort of like business, which typically is the profile of the business angel or angel investor, you can help people to also think about what does preparedness mean in real terms. Like, and again, independently from like how early or how late you're investing, that preparation still is relatively the same. So let me kind of not go through everything in the same speed, but like I think what you should remember is that exit takes way more than it did before, and kind of like you probably know that in macro side we are sort of like slowing down significantly on the GDP growth across Europe. Long-term interest rates are kind of going up. So how does that affect the VC money pool? Is essentially you have higher demand for risky assets to provide returns. If the risk-free rate goes up, you should have stronger conviction that you're able to provide extra return on top of the risk here. And VC and sort of angel investment is like in a very, very far right corner on the risk return adjusted curve, right? Fundraising is relatively, let's say, goes down for PE and even more for the VC. So there's less money available to invest. So therefore, if you think about, I'm investing right now, I would like to divest, as Juris mentioned before, like not in the full kind of holding period, but before, you will know there's less VC money, which is able to buy the companies from you. So therefore, like, again, your company should stand out. And also the deal volume, at least in private equity space, has gone down significantly for the last 3 years, and actually even 4. In VC space, we still have some volatility. Like there are certain years where VC deals are actually going up. But here, you say, again, I'm looking from the more private equity side, and I can talk about because private equity includes the free asset classes under that, which is buyout. It includes the growth equity and includes also the VC, but it doesn't include the pre-seed and seed, which is mostly our asset class goes into. But what you can see is, number one, overall exits have gone down for the 4 straight years in terms of amount. And also types of exits. You can see that trade sale, which is sort of like someone selling the asset to another party, either financial buyer or commercial buyer, is still the most dominant part. Secondary buyout means another financial party bought it out. And then sort of IPO is relatively super small part. And I think that is also, if you think about, this is a global number. If you take European number, that IPO part is like negligible. So like you're talking about trade sale as the main way of exit in Europe. And it's going to be mostly 50-50, trade sale to strategic versus trade sale to financial sponsor, right? And so that, again, just painting the context of exits, like why it is so important to help prepare for that for the target company. This is kind of how we think about in the industry, about the industry health. This is capital called in by the limited partners, and this is distributions provided to limited partners. As you can see that, essentially for almost a decade, the capital called in excess of distributions was significantly up. 2024, if you add here the data, which we already we have for some time, we haven't added here, is actually the first time you have a little bit reversed the trend. So you have some capital going back, but that is really the later stage of the investment cycle. So private equities is returning a little bit more money. VCs are still not returning money. So VCs are still waiting for the opportunity to kind of exit and provide liquidity for limited partners. So fundraising, as you can see, sort of has gone down as well for 4 years straight. And these are kind of numbers last year. Essentially, overall, minus 23%, in North America, minus 28%, Europe, minus 12%, Asia, minus 24.5%. In that space, I think, I don't know, I don't remember, like I don't have here a chart on like VC versus buyout, but here the drop, so the drop in Europe is the smallest, but also the share of VC raised money in Europe is the smallest there. So kind of like we still see a massive drop in a capital. I think this is interesting, but which I spoke about slightly before. When you think about, let's say, financial investor in private markets value creation mechanism, the classical theory says that the value comes in 3 parts equally from multiple expansion in sort of market growth and ability to generate operational value. And sort of like, and then financial leverage would be sort of like the kicker, which is available only to the buyout phase, right? Like in VC, you simply don't have leverage available to you. And therefore, as you can see that when you think about revenue growth and EBITDA growth, which is like 1 times the sort of 1 times the growth, it is the only real availability of alpha generation for the VCs because they don't have leverage and also they don't have an ability to kind of massively improve transaction multiple expansion because there are less levers in the early stage companies to do that. What also you have seen typically, and these are sort of like, again, across the value chain, but like the multiples have increased for 10 years straight from like 7.4 EV EBITDA to like around 12.4. If you think about earlier stage, that goes probably up to 2021.
I hope there are going to be some bright spots because now it looks all kind of shady.
It's gonna be okay. Don't worry. I'm saying surprise for later. At the end of the day, like I think the key idea is
Okay.
I can provide you the fact, and then you can interpret in a way you can, right? Because I think the idea is that sort of no one can frame like what is the great condition, but you can sort of like at least frame and what is essentially the opportunity. Because don't miss a good crisis, because the good opportunities are created then. When is the most successful vintage, by the way, do you know, of the last 25 years in private markets investing?
I don't know, probably the
2009?
2009. So, for investor,
For VC or for private?
for both, for private. So for VCs actually.
Strange that VC is also.
So VC is actually 1 year later. 1 year later. For VC is actually the most successful one is essentially 2010 because they exit mostly in 2021. So the 11-year holding period and 2021 exit was sort of like what created the highest.
It depends on the exit, right?
Yes.
Or private equity.
On entry, more.
On entry.
Correct.
Yeah.
Correct. All right. So I think where I stopped was I kind of mentioned to you that essentially on the buyout side, the leverage is getting lower because of the interest rate impact. But again, on VC side, sort of the leverage doesn't have at all the impact. But I think essentially, when you think about this, also the multiples have, again, it's sort of in VC, it's very hard to talk about like one average multiple because you have so many different asset classes or like industries where you can invest. But today, let's say if you think about, again, you mostly talk about revenue multiples in the VC underwriting because you underwrite on the base of revenue potential. That has kind of more or less normalized, whereas in sort of like buyout space, it still kind of keeps going up. This is kind of less relevant for VC, but I think it's important for you also to understand that, like, because more value creation is generated by the funds themselves in the PE and VC world equally, you see more and more kind of people being involved in real operations on the fund side. On an average, you would have 3.5 to 3.6 portfolio companies per operational partner. In VC, it's of course like that ratio goes up to 1 to 10. So typically in the VC space, you would have maybe 1 or 2 operational guys, and they are like taking care of like all 15 portfolio companies. But that actually is a new and interesting thing which has happened over the last, let's say, 7 to 10 years, where even in the VC community, you would have operational partners with operational experience helping people to organize the house, right? And I think that eventually is also a role sometimes a business angel can play in order to help recruit someone who is kind of feasible for that role, or also partially play that role. And kind of, if you think about volumes of exits, and that's the bright spot, is, and there are many different reasons why, but in growth equity, VC and PE equally, the next 18 to 24 months will produce in Europe alone around 3.5 to 4 billion in exits, because the companies have reached the end of the closed fund life cycle. In European funds, by law, let's say the closed-ended fund can be maximum 10 years with an additional 1 year. So right now, what you see is over the cliff, there has been more than, let's say, and here you can see that in certain funds, you have 30 companies which need to be exited in the next 24 months. So you will see in the market many transactions which will start create the new, what we call like M&A sort of like wave. In that wave, also the early stage will going to be drawn into this, right? Because essentially when you late stage starts transacting, then kind of it goes to growth equity and then it goes to VC. So essentially the opportunity will be there in the next 24 months for also VCs to accelerate the exit. And the question is like, who are going to be the more prepared for that?
And where's the money?
Sorry?
And where's the money? Who's going to be able to buy it?
Who's going to be able to buy it? Yeah. I mean, that's a good question.
Who's to sell and who's going to buy it?
No, but like essentially, I would say if you think about the overall economics of the private markets, the private market total number is 14.5 trillion globally, of which 3 trillion is in Europe. That pie, the $3 trillion, is constituted of around like six asset classes, of which the biggest is the buyout. Then the second biggest would be currently the VC and growth together. Then the third biggest is infrastructure, the fourth biggest is real estate, the fifth biggest is private credit, and the sixth,
Intertoucher or was it?
Sorry?
Third one.
Infrastructure. And then sort of like after real estate, after that is the private credit, and after that would be sort of like everything else, which is like related to like sort of certain specific not natural resources and sort of direct, and kind of comes also into the defense, right? So that's kind of a new topic.
Is this like a repeating cycle of when there's kind of really more expected exits also?
Yeah, of course. Like kind of things happen in cycles, and right now the cycles tend to be, in some ways, in macroeconomical cycles tend to be, and again, like I think here, if you think about Ray Dalio, like he argues that sort of like the macroeconomical cycles are kind of shrinking in expected wave. In private markets, the cycle actually is a little bit wider, like when you have these sort of specific buyer frenzies, M&A kind of fever, right? Like last one was 2021, then before that was 2016, and then 2014, 2015, 2016 was a time where kind of things which were bought in 2008 and 2009 exited. So like that sort of created the next wave of exits and therefore like purchases, and then 2021 was exiting, and right now sort of like the next one you could expect will be around 26, 27. Kind of at least from that 6 to 7 year period, like when you think about, let's say, the large exit story, the money comes in. The problem was that the money which was exited in 2021 was immediately put back into the market, let's say most of that, at very, very high valuations. So right now is that is kind of my main reason why things are not transacting, because the buying and selling expectations are significantly apart. And technically, before, you always could manage those expectations via structures. You can give them sort of like liquidity preference, you can give them the earnouts, you can give them other structures. But right now the gap is so large that no structure really can sort of overcome that. And therefore sort of the exit market struggles in that context. But the money is there. The question is like, the market is changing so quickly that the things you expected to be great in 5 years are not as great today. And that is kind of the key problem. The money is not the problem, the quality of the companies is the problem. And I think for the great companies, there are going to be fantastic exit opportunities because like everyone will want to invest in them. So therefore, there's going to be a very few, very, very highly valued winners and a bunch of zombie companies who are kind of not able to raise next round and are going to die very, very soon. And that is sort of like a little bit like the good and the bad, right? If you're exposed to the right one, you're going to be disproportionately compensated for that. But right now, if you're not able to kind of pivot or reimagine like how you are entertaining the sector, then perhaps the exit problem is kind of when you think about that. By the way, how much time I have? Like, because I can cut and
20 minutes.
Okay. So therefore, like what I think is important. So the context is, in macro context today, it's not easy to exit. I think it's like if you have the right company to write the right story and ability to sort of like pivot from the initial investment thesis and create value, in the next 24 months, you'll have fantastic exit opportunities. That is sort of like the most important thing. If you're exposed to those companies who have that, I think you will be in a good position. Now, how does that play out? It depends from the structure, how you invested, either via fund or via syndicate or individually. That will kind of really depend. So therefore, like what I'll try to do now is I'll a little bit like talk about the exit excellence approach which the best funds are taking and how they are doing it, and like then if you are investing through fund, how you should expect them to act or behave. And then like if you are investing directly, like what can you do in order to improve that exit success, okay? So if you're a fund, then I think you would expect your fund partner, right? Let's say I'm an investor or LP in 2 Baltic funds. I expect them to do certain things, like for example, have kind of exit route be shaped accordingly already in the investment process. So like the deal journey starts on the day you purchase the company, right? Because I think that is, to me, the key thing in the VC people typically omit, right? Like they say, oh, this is a great idea, great founder, I want to support the team, but you don't think, is there kind of a deal journey which kind of leads to an exit in the very beginning, right? And I think that is sort of again a cardinal sin from my perspective. But therefore, if you're investing through a fund, the fund should never take that mistake. So like my sense of the deal journey, this mindset is important when I kind of evaluate the fund partners I actually select. Second is, if you kind of as the fund can already develop from all your portfolio companies like a viable scenarios, what is possible and what is required for that to be enabled, right? Let's say standard one which we discussed is strategic, like financial sponsor to financial sponsor, financial sponsors to strategic, trade sale, IPOs, and then sort of what else? Then you have GP-led continuation vehicles. Like let's say right now in the Baltics you have like 2 continuation vehicles happening. Again, from a late stage perspective, different LPs have different considerations. Early stage perspectives, continuation is not good because you're not getting the cash back. Like you have heard, probably in the Baltics, you have right now the first 2 open-ended funds opened up, right? Like there's also like a small evergreen fund, right? So like those structures also kind of you think about, is my company interesting for those? Because again, in other European countries, you have also like, let's say, a certain trend of roll-ups. And those roll-ups typically look for smaller acquisition companies in different markets where they can have their geographical angle. So are you as an angel exposed to those companies? Therefore, can you enable that roll-up route? So exit route.
Did you mean open-ended VC funds are kind of appearing or?
Open-ended, so like no, when I say open-ended, right now they're not open-ended VC funds. Later stage open-ended funds, not VC. So they would be kind of like a family office type investment vehicles. Like I know of one in Latvia.
Oh, Prokofiev's one.
That is Baltic Family Capital. That's a different one. That's an evergreen structure, allegedly. Like well, let's see how it opens up. But there's one in Luxembourg, which is one of the families here locally. It cannot disclose. No. But so no, not VCs. In the VC fund, you simply cannot create that structure because the VCs.
You can exit. I guess for the private equity, you'd have the same kind of problem.
No, but like for the VC, also like in private equity, at least you kind of say, like I want to be the holder for the next 5-year cycle, and therefore I'm gonna open up the continuation vehicle, and I need to get every LP on board with me or not. Like I have to buy them out. In a VC, kind of you typically don't have the money to buy them out. You don't have the next fund, right? So like therefore it's very hard, or like I wouldn't be able to imagine the structure where the VC would have an open-ended structure. But like here the whole point was, are you thinking beyond what was traditional 10 years ago? Because today you also have many non-traditional options available. So are you aware that they exist and how you can support your fund partner to do that? Kind of the underwriting quality, like how you do the underwriting of the deal is important for me also, like in a selection process. Exit readiness is how you have cross-portfolio alignment and prioritization of exit strategies based on the market signals, or depending from which type of company you have. Let's say right now, let's say if your company has a dual use or defense angle, act now. If you have, let's say, a tech angle, wait, perhaps would be the strategy. And then sort of like also how you think about the next owner, because that is kind of the mindset. If you think about the next owner deeply enough, you'll have kind of understanding who are the buyers, which you're kind of mapping against. Can you establish relationships already today? Are these, let's say, buyer landscape mapped aligned with what you think about potential exit routes? And also like how you think about the next macro cycles and the timing, right? And that's kind of why I said you should have a conviction as a fund when the next exit process will come. Let's say my perspective is that the next relatively uptake and exit activity is going to be end of 2026, beginning of 2027. How your portfolio is positioned against that timing is important. But this is again, like it's kind of from the fund perspective, you would like to say, again, can you map specifically also initial mapping, let's say just 2 examples, sponsor to sponsor transaction, which is like fund to fund, and then strategic sale, like what considerations people would have and how deeply you as a fund think about these things. I think from angel perspective, I don't think it's like you would not do that, but like as I said, as an angel, I'm investing in funds locally. So when I kind of think about that, I always can try to think how deeply they think about the mapping of the potential buyers and the needs they have. And then of course, like when you actually do the exit, do you do the strategy for the exit? Do you do value capture sprints? Do you do the vendor due diligence reports and how high quality they are? That is part of the preparation as the fund. as a VC, PE, or growth equity equally, like you should have some of these things mapped out. So as the fund, as I said, if you already have invested, I think you already made certain decisions on the quality of the fund management team, but at least right now, at least institutional LPs, when I think about the funds, they spend disproportionate amount of time thinking about the quality of the exit processes and how they think about the DPI, how they think about, let's say, giving the money back as it was 10 years ago or even 5 years ago. So therefore, you as individual investors should do the same. So because the angel investment doesn't mean only you invest directly into the companies. You can invest via syndicate or via fund. And when you do the selection of the funds you like to invest in, keep in mind that the exit excellence process today can be defined very precisely, and you should demand that from your fund partners. That I think is a very, very critical thing to think about. But let's quickly finish off. We're talking about what can you do or what you should think about as an angel, because when you kind of reach that midpoint, right? And here I'm specifically talking about the fact that you're able to exit, let's say, quicker than the aforementioned 12 years or 10 to 12 years. If you have a chance kind of to jump out quickly. So how you can increase the chances of an exit in between, right? Which will be in between rounds, you create an opportunity for you to really exit, right? Like what are at least elements which I could consider as thinkable, right? So thing is, like, be collaborative, because the early stage investors typically also, and again, depending from the sophistication level of these investors, you can have someone who is very open and very collaborative, and you have someone who is just like plainly putting obstacles in the exit route, right? So I think you, as someone who is interested in the transaction, you should be able kind of to be collaborative and with the founder and their advisors in order to create like a perspective of the company.
What would be like some of the obstacles that an angel could be putting?
I mean, so one is you try to clean up the cap table. You offer them to buy out the safes with a pre-agreed margin, and you kind of decline. You, let's say, don't sign on the certain documents which are required for you to say that you have been informed about the potential risks. You don't. There are certain angels who are acting as board members, and they don't sign like on an audit report or like quality of earnings reports. You have different behaviors, and they're motivated by different people. I have seen quite a lot in different things. So I think the eventually, like, the idea is you should be as collaborative as possible, but also like you should kind of, and then we can really talk about like what you should be aware of, right, in that process. I think proactively aligning within the group of angels is very important, because nothing is worse than for a founder to spend time talking with 24 different angels. Like, founders should focus on the company, not on like pleasing every single guy who wrote them $25,000 check. So effectively, like, just think about that ROI on his time is significantly more important than your ego. So like, therefore, like, collaborate, align, and proactively make sure that he has to spend as little time as possible aligning with people who are backing him early. But he of course should be respectful towards them. But like, you should proactively offer that as an opportunity for him to kind of put it on a slow burner and make sure like he can align once, not 24 different times. What I've seen a lot in the Baltics and also in the Middle East, where I spend a lot of my time, is people cannot keep their mouth shut. And I think that is sort of like what angels do not respect confidentiality rules. And I think how many things I have heard about the process which should not be public from someone who has invested in a company, right? And I think that is just cardinal sin, right? If you do that, and I'm another angel in that round, I should essentially slap you, right? Because you are decreasing opportunity for this transaction to go through successfully, right? And I think confidentiality rules, especially in the small markets like these, are of utmost importance. If you have heard something from the founder in a Zoom call, keep it to yourself, right? Because as well, like, he might give you a hint which is very much ahead of the schedule, right? So he has talked to that guy for the first time, and then like, if you put that name out, kind of it gives all the vultures in the market, which are, can be different, right? Different buyer, different seller, different advisors, kind of trying to make sure they have room for the deal. And all of a sudden that can scare away the potential buyer, right? So I think confidentiality is very important. And also be open to different liquidity options. As I said, like, I think sometimes if you're offered something, secondary options, repurchases, like earlier stage, if you think, and here comes a little bit like the trust and And sort of, again, most people would argue, yeah, like I don't trust that person. Maybe like he is trying to buy cheaply from me and then sell expensively to the guy right kind of in 5 minutes after. But I think try to be open to value different options, right, as they come, because sometimes it's easier to do a deal if you have, as I said, kind of get the house in order from the technical standpoint. But what you should be aware of, and I think this is kind of something which I already mentioned before, is so most of them will go to zero. That's fine. So don't be like emotionally attached to one single investment because it's a portfolio strategy. Angel investing is portfolio strategy. So what you're doing is you're putting money in 8 companies. You hope that 4 of them will die, 2 of them will give you back your money, and 2 of them will give you 4 to 10x your money. And that strategy over a reasonable time frame should generate you approximately 15 to 20% gross IRR, right? But again, that is a time-bound strategy, which means that is kind of not the full 9 yards of like 15 years. If companies don't go bankrupt in angel stage, it means you don't take enough risk. If you don't take enough risk, don't do angel investing. Remember that. If you invest in 8 companies and none of them go bankrupt, you go too late in, and therefore none of these companies will have potential to be 100x. I'm not saying that in Latvia you have many of those companies in general, so you are kind of constrained. Lithuania is in better position, unfortunately. But essentially, if you are doing early stage investing and you don't see at least half of them going bust, you're not taking enough risk. And therefore, like, if you are afraid of risk, don't do it. I think that is just something like which you should anchor in your mind. Like, you are doing this to see half of them die and be happy about it, because then it means that perhaps you are taking enough risk to also see that one company which will return back your portfolio. So therefore, my rule of thumb would be never invest in less than 7. 7, 8 is kind of like arbitrary, like where you would think about the line, but like I think 7, 8, and the check size should be similar. Is it 5,000, 10,000, 25,000, 50,000, 100,000? Should be always the same. And again, I'm teaching because I made a mistake. Like my check size was 1, then I did 1 company of the 4 times the check size, and guess which one went the bust? And that also goes together with a rule of thumb, which my very first mentor in investing kind of told me. He said, never put good money after bad money. And kind of you have this conviction that like, I really think this idea is great. You have like biased thinking that this guy is great. He's gonna make sure it happens, right? Then you already kind of have tripled the check size because you kind of really believed in this idea. And then sort of like the thing comes something which is called pay-to-play round. Has any of you participated in one?
What is?
Pay-to-play round. No? I'm surprised. So pay-to-play is when company runs out of money, essentially everyone comes to the table and you say, to continue the party, everyone has to chip in. Basically the same amount, which is respective to the kind of safe conviction, right? Like you kind of sweep the cap table forward, and then the ones who doesn't, they don't participate anymore. They have effectively been wiped out already. So when you have the pay-to-play round, there's a decision, right? I forget about it, or I put a new money after that. So my advice to you is never put good money after bad one, because that bad one is like he went out, that's it. In a very, very few cases where kind of really timing sucks and like really there was something kind of cash flow wise which really didn't work out, 9 out of 10 times, the company will also die after the second re-app, right? So say, fine, I'm glad. One of the 4 I need to die died. Let's move on. But I think that is important, right? Because, and I did it myself. And I learned the hard way. So don't put good money after bad money, and also don't necessarily, because you think this idea is better than the previous one I invested, let's not double the check size because of that. Always keep consistency in angel investing, because otherwise, like, you're going to burn yourself very much. Always talk with the founder on your expectations about investment. In the beginning, as you do that, you say, I give you this 50,000. I expect to get 4 times back in 5 years. Can you do that? Because essentially, as the idea he paints you, he should be like, of course I can give you that. Because if he can't, you shouldn't, because he is not visionary enough to sell you the idea. But if you kind of have expressed him explicitly what is your minimum acceptance, when you have this idea about liquidity options he wants to create for you before the deal, so to ease the deal for the next founder, you can refer back to that conversation. You say, like, you remember, like I said, I want 4 times back. So don't offer me 100K for my 50, offer me 200. Maybe we can discuss the friends and family discount of 195, but like I'm anchoring around 200. If you have expressed that very specifically in the first conversation with the founder, you're always going to find yourself in a better position because these discussions will come up and there's going to be something to look back on. So always talk about your expectations, and you say this is because individually, you don't have to talk about your portfolio perspective. You have to talk about your individual investment perspective. So you're investing in a guy, and you say, I want you minimum to create me 4x in 5 years because I'm taking a lot of risk for this. And if you anchor that around that number, then it's easier for you then as you think about liquidity to say, number one, when is enough? Number two, like when he offers you something, you always can go back to the first referral, right? I found that very, very helpful. If you kind of, in your mind and also verbally explain that to the founder, like what is sort of like your expectation of this specific investment, time bound and sort of like multiple bound in some ways and forms. Because then he cannot anchor you on something like which is significantly lower. So this perhaps, at least what you should be aware of is, does everyone understand tag along and drag along rights? Yes? Or should I give a quick just 10-second explanation? Okay, everyone's like, I'll not, so basically clear time frame and diagonal triangle right should always be there because for the angel that is important. Because if someone is creating a liquidity event and you can be still illiquid, it doesn't really make sense because that will sort of kill your potential return because then you're dragged along for longer and your IRR is going to go down because of the time factor. And one other specific learning I kind of learned the hard way multiple times is there is certain rush sometimes to improve the company's financial position, and therefore they're offering to convert your safes, so which is kind of the convertible future equity promise, right? Promissory note, convert your safe early, so you become a real equity owner. Because sometimes people are excited, oh, like I want to be equity owner. Like I don't want to be a safe owner. Like it's not really like a full thing, you know. I want to be like equity owner, right? Don't do that. Because equity ownership means you have ownership rights to the distribution of profits and losses. If someone is asking you to convert early, it means like there's higher probability of losses than profits. And then eventually when you will have a bankruptcy case, sometimes in some jurisdictions, in some industries, you also face personal liability as an equity owner. So if someone asks you to convert, politely decline. Because the probability of the sharing of the losses part is going to be higher than sharing of the profits part.
With the conversion, do you have to pay in to arise in your equity?
No.
Or how does conversion work?
Because it's a convertible loan. I give you the convertible loan and I sign a safe note and I have conversion rights with, let's say, into the equity. And I'm basically, then I have to go to the local registry of the companies and they're going to be say, oh, Martin's a 25% owner of the company. And then you appear in the registry, you're like, oh, I'm equity owner, fantastic. And then you realize there's like a tax liability against the state. There's employee liability if you're going bankrupt, right? And then there's like administrative liability, like if things happen, right? So like I think, and in certain cases, some of the liabilities might be against you personally as an equity owner. I'm not sure about Latvia or Baltic specifically, but like in other jurisdictions, that actually exists. As I said, like I have invested in Latvia, Lithuania, Estonia, Spain, Portugal, Saudi Arabia, UAE, Turkey, and in some of them, it actually is a real thing. So don't do it. Lastly, like as I said, the value creation phenomena comes into the early stage investing fast. What can you do? Because let's say I made a rule of thumb that I will not do any investment where I personally cannot increase the probability of success of this business. Like if I'm only money, then I have no business of being in there, right? So then what are the things you can do to significantly increase the probability of success?
Could you name an example of your own
Of?
of such thing where you have chosen the investment based on your ability to add value?
So improve value? So let's say, so one of my investments is in largest dark kitchen in Turkey. In a McKinsey, I was doing consumer, and I have done, let's say, around 30 due diligences across different assets in the world on specifically consumer, of which 10 were cloud kitchens. So I kind of know inside out what are the good looks like, how are the operating models. So actually I can sit with the founder and I can help him think through these things because he has seen his thing and perhaps one more. I've seen 10 of them. So at least I can give him the wisdom of the crowd or international angle, which he perhaps doesn't have. I have investment here in Latvia in a company which is invested in the US, or like does something in the US, right? Like the person has been in the US once and kind of has no idea about like, let's say, even like how does the Avalara work, like for like the tax thing, if he has like increased certain things. And so just awareness of the market and kind of trying to understand certain things, right? So the list goes on, right? Like there's certain things which comes from the personal experience, which you can sort of like either from professional angle or personal angle, you can help people to understand quicker, kind of overcome certain things or problem solve certain things very specifically.
So for you, it comes out from the consultancy you've been doing for
Yes. A lot of the deals for the clients, kind of I try to apply like what I see, how good looks like in some ways. Like of course it's kind of much later stage, so like therefore I have to think what is relevant for the super early stage. But like at least from conceptual standpoint, yeah, most of the things I've seen on the work. So the number one thing which you can help founders is every founder like initially traction is measured by sales. Every founder should be a good salesperson. Every founder is the first sales guy of his product, solution, service, right? So getting the right introductions with the key decision makers or buyers, I think is very, very critical. A good reference to say like, hey, talk to this guy because his solution is helping your business to save X amount of percent is one email from you, but that can be very, very critical to get like the first 5 or first 10 people on board, of which he can get references from. So therefore, like helping founders find the right introductions, I think to me is the list number one item every angel should do. Number one, every angel should use the product or service if that's a consumer product, or if it's a business product, try to use it in your own business, because if you as an investor don't use the product, like why should anyone else? So kind of think about that. So because that kind of links to kind of be a promoter, evangelist of the product service, so use it, and therefore do introductions based on your personal experience. That is kind of very, very critical for me, from my perspective. Number two, every founder should be able to, let's say, if you invest in very little stage, like the team is like 5-10 people. For your investment to go 4x at least, the company should have at least 100 to 150 employees. So the founder himself will have to recruit, convince to join the small team, at least 90 to 100 candidates. To get to 90 to 100 candidates, he probably has to review 1,000. So if you can refer good employee candidates for key positions early, that is what good angels should do. And lastly, like the founder is very busy. So like he doesn't have time to read through different things, and in your kind of change of life when you see a deal in his adjacent space happening, someone buying something, someone doing something, do the courtesy of like sending him a short note saying, hey, I saw this. I thought it's interesting, right? Because sometimes from these ideas, some of the exit journey has started. Like some angel actually sees a deal, creates a connection with a potential buyer, and that buyer 5 years later buys the company. So these are the 4 things, at least in my perspective, what every angel can help to enable and kind of do as they prepare for the exit. And lastly, I think every next buyer will need higher quality of the information systems and governance process for the company, because you are buying future ability to generate future cash flows for the company. So therefore, you as an early investor should and keep pushing and demanding higher standards for financial forecasting, financial transparency, operational transparency, and commercial transparency. And that is also something what should be our objective as an angel investor, right? I don't see like all of them should be part of, let's say, the board, but like, let's say one angel investor typically should be in a board and should keep talking about this. Because as you do that, you significantly increase the opportunity and probability of that investment to be ready for exit in the first place. I think that's it from my side. I hope I didn't took too much of the time, but
No, it's okay.
I think essentially sort of the context, as I said, not everything is doom and gloomy. Like there is an opportunity for the right companies, but the market is tough, right? And let's also be very open about that. Don't expect your founder to be a miracle maker because essentially the market is tough. If you're investing via the fund, your fund should always be prepared and understand how the processes of preparing a good exit look like. And if not, teach them the hard way. And as a good investor, like there are certain things you can help and do and be proactive with, and certain things you should be aware of. That would be like what the couple of thoughts I leave you with. So I guess thank you and Emil's.
Round of applause to Martin. Any questions maybe straight out of the
Yeah,
gate
exactly.
for Martin?
Any questions?
Well, when you make your own investments, how do you assess the value and you know, the multiples?
So the value actually, to be honest, like, yeah, so this is probably something I should say in the very beginning. It's impossible to assess value at such an early stage as we invest as angels, kind of, and to me, it doesn't really matter. To me, nothing which is more than 10 without real commercial traction and proof, which has, let's say, at least 3 or 4 quarters of increased sales numbers, real people I can call and say like, why you use the service, like how it is, blah, blah, blah. Any valuation metric without that traction above, let's say 8 million, like seems weird to me. So, because also like from the mathematical standpoint, let's say your check size depends, like whatever, like what your idea is of this. But if your check is between 25 and 50,000, then sort of investing in something which already is pre-money valued more than 10 million in a pre-series A, you'll not be able to get back the amount of money you need. So it means like you have to, in one of your 7 things, shoot a unicorn. So that's kind of like the back math to me is like, I never do more than 10. I rarely do more than 8 pre-money valuation. But like, is it 1, 2, 3, or 5? Doesn't really matter. So I don't spend too much time if I don't have real commercially viable data traction data to justify certain kind of valuation numbers. So therefore I don't actually spend too much time on that. What I spend more time is understanding the founder references, like who can actually say that this guy is the guy who's going to go through the walls. Is he the guy who's going to hire the next 5 fantastic talents? Is he the guy I want to give money to because he's also then able to convince investors to give money to? That is where I spend more of my time.
Market, scaling?
Nothing. I don't care. I mean, again, idea should be there. Like idea, I should say this is a wow idea, because to me it's like my wife when asked for like advice, like is this dress good? To me, there's only 2 answers. Is it wow or no? Is hell yeah or no, right? So like to me, therefore, like, and this is the same. Is it hell yeah or no? So like if I don't think the idea is hell yeah, then like it's no by definition. And on the hell yeah idea, like I don't spend too much time on the product market. There has to be, I think, out of these classical valuation things in kind of an early stage, I would probably spend zero relevance to me. 0. Go to market. Do you know how people make decisions in the market and how you can go to market and like why you would be the most obvious choice? Like go to market and just feasibility that go to market, I would check, I guess, right? And then question of the guy. Is the guy good? Is the guy credible? Is the guy with good values? Is the guy who can walk through the walls and get to the solution? Is the guy who's going to be able to hire the right 5 people? Is the guy going to be able to raise at least $25 million? If the answer is yes, then here's a check. That is, again, I'm not saying it's good or bad. I'm just saying like spending, because it's a false precision. No one knows. Angels invest in such a high uncertainty that like anything you're going to say like, oh, this process just looks better, like, oh, this is kind of scoring of like 5 stars, 4 stars, like multiplications. Nothing. To me, that does matter. Later stage, as you do real estate, everything is numbers. Like late stage private equity, numbers. Early stage venture, to me, is like just under people. Yes, sorry.
You said 8, 10 times. That's why.
No, 8 to 10 million pre-money valuation.
Okay, that's the max.
Million euros, $1 million, whatever you want to say.
Okay,
Yeah.
That's the top.
Yeah, that's the
side,
top. That's the top
right.
for me
The
personally.
ones that you
No, because otherwise you cannot get the number. Yeah. I like 3 to 5. I will go rarely over 8, never over 10.
How do you feel about the portfolio you have? Do you see them delivering the return you?
Are 4 already written down?
One is written down. One, the largest check, so which was three times the average ticket size, which was stupid. I have 2 which are unicorn potential, I would say. One is in Turkey, one is in Saudi Arabia. Turkey really is affected by the inflation and currency devaluation. Like they were able to get most of that down to the consumer. So therefore there is no necessarily idea, but you invested in dollars, so therefore you expect dollar returns. Why GCC investment or Gulf investment is good, because you're investing in dollars, and every single Gulf currency is pegged to the dollar. So you essentially have let's say emerging market macro, dollar denominated. So therefore investing there makes more sense than here, for example. And so therefore I think for my portfolio, I invest in the Baltics simply because I want to help Baltic founders. But I don't think it's going to be, overall portfolio construction is not going to be the best performers. So my biggest return expectations come from Middle East, actually. Middle East and Turkey.
Yeah, Pavel.
Yes, sorry, I was greatly saddened by you saying that the leverage is not applicable in venture. I'm doing venture debt, although you're right that the leverage is quite small.
Okay. I'm sorry to offend you. So venture debt is actually interesting. One of the companies I invested in actually recently got a confirmation because they did a round of 30 million in growth equity, and they immediately got an offer from SVB to add 10 million venture debt on top of that, right? So venture debt exists. But what I meant to say is that you as the investor don't have leverage, because the debt is provided to the founder, to the company, not to the buyer. Because the leverage typically for an investor in any transaction in the private markets asset class would boost your equity returns, because you have a leverage. In this case, what I meant is that you don't have leverage against your equity. Like a founder has options to get venture debt. Yes, for sure. And then the question is how greedy you are, how many warrants you want, and then how many different specific rights you want. Yes. Point well taken, and I'm glad that there is a venture debt available in the Baltics. Yep.
So did I get correctly that your ROI target is 15-20%? Or
IRR target. Yeah, IRR target would be between 15 and 10% net of everything, yeah.
okay. So this is kind of tracing back to DCF.
Not really DCF, how I think about that is to say, I have, as I said, to me, I want to invest, or I didn't want to invest in 10 companies, similar check sizes. That I didn't really do because I had a little bit of variation. And then also because then there's a question which we didn't talk about follow-on rounds, right? For certain things I actually did a follow-on rounds. And that's also something you should think about already in the get-go. So typically in the fund level, you have 50% in your initial investments and 50% in follow-ons. You should reserve, because then you want to put more money in your really successful ones. That is kind of also something I forgot to mention. That is kind of important. So you should think about 2 things. One is how big is your initial check size, and that should be consistent across all the investments you do. And then how much total money you want to dedicate to this specific sub-asset class. When you have those 2 equations, then you can understand 50% of the total money you should leave aside to follow-on rounds. 50% of the money you should divide equally to the number of companies you want to invest in. From, let's say, everything, my expectation would be to get between 15 and 20%. Which includes the follow-ons.
Or before inflation?
I mean,
So, it's a question.
no, it's a very good question. It's a very good question. So my calculation goes the following. I have spent X amount of money.
I say 1 million.
DPS, so 1 million, perfect. 1 million, I got back, let's say, 3 million, let's say, in 5 years. That's 25% IRR. That's net. That's net, sort of net of everything. 3 million back in my bank account. Not this was sold at this, because then you have fees, and you have FX fees, you have transaction fees, everything. Money in, money out. So MOIC is free, IRR is time bound to that. I hold it to 7 years, it's 15%. Realistically, I'm gonna probably hold it longer, so like 3x will not satisfy my return. I need 4x. So how I'm thinking mentally about is 7, 8 years, 1 to 4 million would be kind of the math, which I would do mentally. That is sort of like how success looks like. And then
So this is like a best case scenario.
best case scenario. No, I mean not best. That's scenario you work towards, because essentially like one of these transactions can. Yeah. So how I think about that is exactly as I said. I have 10 investments. 5 will die. 3 will give back 1 to 1.5x. 1 will give back 5x. 1 will give back 10x. I need that 10x for this to work out.
How does it correlate to your statement that 9 of 10 will die?
Exactly like that. I said 5 will die. 3 will give you back 1x.
But if you have 10,
Yeah.
only one should survive based on that logic.
I mean, the 1 will return you a refund. Like 1 is give you 10x, right? I'm ready. I hope that not, but like I'm ready that 9 of them lose. So what I said is like at least 50% should die. 3 or 30% should return your money. 1 should return 3 to 4x, and 1 should return 10x. That's an ideal scenario. That's an ideal scenario. And if that 1 is not 10x, but like 15x, then you get more than 15%. Because then the question everyone should ask reasonably is, are you, let's say, competent enough for the risk you take? And my answer is no, you're not. But I don't do it because I think it's a financially great thing. that's a statement I should also like say up front. I don't think it's a financially great thing to do. Sorry, but I've probably taken enough time.
All right, thank you.